Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 6th of November. I'm Daniel Lam, your host for the podcast. Yes, this is our second podcast for today, as we're doing Thursday's podcast a day earlier, because we want to provide you with our latest thoughts following the US elections. Trump is on the cusp of victory as the next president of the United States. The key question now is, what would be the short-term price action and the medium-term implications? Well, in the near term, we anticipate US government bond yield level and volatility to remain elevated due to expectations of fiscal expansion and higher trade tariffs. We see further short-term upside in the US dollar index as markets anticipate a reduced regulatory burden and more tax cuts. Trump's tariff-related trades are likely to become the main focus for equity investors. Our review of equity sector performance after tariff-related news headlines when Trump was president back in 2018 and 2019 shows that defensive equity sectors, such as utilities and consumer staples, performed well in the lead-up to the peak in tariff-related news. Trump's America First stance also lent a tailwind to U.S. domestic small caps. The aerospace and defense sector also benefited because of increased geopolitical risk and Trump's efforts to push Europe to raise its military spending. The energy sector, a traditional Republican mainstay, gained from policies to support energy independence and boost domestic output. Trump's proposed policy agenda would support a repeat of this performance. Conversely, EM assets, particularly Chinese equities, bore the brunt of Trump's tariff threats. Now, China's more proactive policies to support domestic consumption should help offset some of this effect. The semiconductor sector could suffer in the near term, though, due to restrictions on exports to China. Now, looking beyond this immediate concern, we believe U.S. growth and inflation path is key to the long-term path of U.S. bond yields. Import tariffs are inflationary and a headwind to growth. Fiscal spending policies should help counterbalance this, although the resulting higher U.S. government bond supply is a risk. Overall, these policies are likely only incrementally inflationary, which is why we expect the Fed to remain on its rate-cutting course. Therefore, U.S. government bond yields are still likely to move lower longer term, despite short-term upside risk, and hence medium-term investors should still lock in the yield levels that we're seeing right now. We're expecting the dollar to ultimately weaken, a combination of upside inflation risk due to a fiscally expansionary government agenda, and further Fed rate cuts due to softer, but not extremely weakening data. Therefore, short-term dollar strength would likely present an opportunity to reduce exposure. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.